Europe's largest bank is about to get a whole lot smaller. HSBC plans to cut as many as 50,000 jobs through 2017. It's all part of CEO Stuart Gulliver's effort to restore investor confidence in a bank that has been battered, I should say, by a series of scandals and surging compliance costs. Jonathan Tyce is with us from London. He covers the bank for Bloomberg Intelligence. Jonathan, sort it out for us, if you will, because I think our viewers have been hearing two figures today, 50,000 and 25,000.
Both insane.
Sure. The truth is both, but they get to that number in different ways. Help us out.
Well, absolutely. In terms of what HSBC themselves are doing, they're disposing of two businesses. Those people won't necessarily lose their jobs, but that accounts for half the figure. What HSBC have said they'll do is they're going to then cut their headcount by up to 25,000 people, a lot of which will be back office, and they're going to spend a lot of money investing in IT, web-based solutions, etc., to try and pick up some of that slack. But HSBC per se, and jobs at risk at the moment, that's the 25,000 figure.
Except one of the issues many banks face when they decide to cut back office and go to web-based services, the jobs don't actually go away. They still need teams of people to implement those services and really a protection, because they don't want to have only the internet, only online options. So does it really cut jobs, or just cost more money?
If you look at HSBC relative to a lot of banks, because they've been very acquisitive and bolted a lot of different businesses together, their back office to front office staff is a lot higher than most other banks. So whilst I take your point, there's certainly a fair bit of fat that they can cut, and there's a lot of IT consolidation, etc., that they should be doing that they haven't done to date.
Jonathan, what ultimately is the motivator for Stuart Gulliver? Is it a simple number, a single number, like price to book? HSBC continues to trade at a discount to book value.
I mean, the motivator is the fact that, along with JP Morgan, it's designated as the most systemically important bank in the world, and that brings with it enormous capital charges. So basically, HSBC needs to rejig itself so that it can relieve some of this capital burden. And clearly, emerging markets businesses, high credit risk, etc., those are businesses that the PRA in the UK, which is the regulator, are now looking at. The Bank of England stress test is specifically targeting Asia and emerging markets to try and figure out whether it's asking banks to hold enough capital. So the motivator is to improve returns on equity, which by definition should then be reflected in higher price-to-book multiples.
All right. What then is why is it that so many CEOs, Stuart Gulliver included, won't make the other logical decision, which is just to get smaller, to break up? If your bank is so large that it is among the two most systemically important institutions in the world, the regulators are effectively telling you, it would be a lot less costly to be a smaller bank.
I mean, one of the other things they've announced today is they're shrinking risk-weighted assets by a quarter. So they're getting rid of very nearly $300 billion of risk-weighted assets, which will be significantly more in total assets. So they are shrinking. I think one of the interesting slides from their presentation, they show how the regulators look at them and JP Morgan and Citigroup. And for them, because they have so much cross-jurisdiction business, because they facilitate a lot of client business, that's what really gets them in trouble capital-wise. Whereas if you look at a JP Morgan, or you look at a Citi or a Barclays, and you look at their regulatory score, it's complexity. So HSBC is shrinking.
Could HSBC consider just getting out? I mean, when we look at businesses they have here in the United States, security businesses, banking businesses, they have the headcount, but you don't even see them anywhere in the league tables. Could they take a look at this and say their credit business, their mortgage business, some investment banking units simply don't make sense?
I mean, one of HSBC's role is to facilitate global clients all their needs. And one of the things they've been very clear about today is that dollar business, the US's relationship to world trade flows, is vital to their business. So they're actually committing to improving profitability. Will they shrink certain businesses? For example, long-dated US rates business, etc. Yes. But are they going to bid a retreat from the US? They've quite happily acknowledged they can't, because their clients and the US's role within global economies is so great that they have to have a good presence there.
Jonathan, you pointed out that HSBC is shrinking by virtue of giving up, or at least reducing its risk-weighted assets. Ultimately, is that going to persuade the regulators to apply a smaller capital surcharge?
Going back to the point we made just now, probably not, because it's not about complexity. It's about the fact that they have all these cross-jurisdictional businesses. That said, they've told us what they think their kind of unfunded capital requirements are. It's about up to 44 billion, which is a lot less than you could get to if you wanted to be harsh. So clearly they're comfortable, and the fact they've given us a progressive dividend promise again, they're comfortable with the capital position, and clearly they've talked to the PRA in the UK, they would have talked to the Hong Kong Monetary Authority, so they will shrink, but I think capital-wise they're probably in a pretty good position.
Jonathan, we thank you very much. Jonathan Tyce of Bloomberg Intelligence with us from London this morning, talking about 50,000. Yes, it's 25,000, but also 50,000 jobs being cut by HSBC. Half of those jobs will end up in somebody else's hands.